Imagine there's a group of financial elites on Wall Street who disdain staring at stock charts like ordinary traders every day. Their approach is much cruder. They buy entire companies outright. And their goal isn't some measly 5% steady return, but to play for big stakes. Buy a company, lay off half the workforce, triple profits, then package the company as a business miracle, and sell it at a huge premium. Who are these people? They are private equity funds, predators in disguise. Private equity firms always pretend to be saviors. We're here to save this company and make it great again. But the truth is, they don't care whether the company lives or dies. Why? Because they have a magical set of tactics that allow them to make money and exit regardless of whether the company survives or it collapses. What is private equity? Simply put, private equity is buying entire companies and then reforming them. They rarely use their own money. They raise funds from pension funds, university endowments, and wealthy individuals. Like real estate speculators, they claim to be transforming companies to make them more valuable. But there's a huge trap here. Leveraged bailouts, which means making the company buy itself. This is private equity's most insidious trick. Suppose they want to buy a $1 billion company. They only put up $200 million of their own money, then borrow $800 million. Here's the catch. It isn't borne by the private equity firm, but is placed on the acquired company's books. It's like buying a house with 20% down and 80% loan, but the house has to pay its own mortgage. Sounds absurd, right? But in the business world, this is completely legal. The truth behind creating value. When private equity firms talk about creating value, what they really mean is mass layoffs, Toys, Oz US, 30,000 jobs lost after acquisition. Cutting long-term investments, raising prices, squeezing suppliers, delaying equipment maintenance. Simply put, they drain the company's blood to make short-term financial statements look good. Then, sell it quickly. Money-making weapons. Private equity funds have 3 money-making weapons. 1. Management fees. Regardless of profit or loss, they charge 2% of assets under management every year. Managing $10 billion means earning $200 million without lifting a finger. This is the ultimate version of making money while sleeping. 2. Performance fees. If they successfully sell the company for a profit, they take 20% of the profits. It's like a casino taking a cut. They get a share when they win, but walk away when they lose. 3. Dividend recapitalization. This is the dirtiest trick. After acquiring a company, they make the company borrow more money, then take that money as a special dividend for themselves. It's like using the company's money to give themselves a bonus. Real cases. Destroyed companies. Let's look at some blood-curdling examples. Toys, R. US. Acquired by 3 private equity firms for $6.6 billion in 2005, saddling it with massive debt. The company went from selling toys to paying interest, shelling out $400 million annually. When it collapsed in 2017, 33,000 people lost their jobs and didn't even get severance pay, while private equity executives pocketed $16 million in bonuses. Hahnemann Hospital. This 171-year-old Philadelphia hospital provided medical care to the poor. After being acquired in 2018, the new owners separated the hospital from the land, then deliberately drove the hospital into bankruptcy to sell the land. As a result, 500 doctors and 800 nurses lost their jobs, and tens of thousands of poor people lost emergency services. During the pandemic, the city government wanted to rent the empty hospital to treat patients. The asking price was $1 million per month. ManorCare Nursing Homes. After being acquired by the Carlyle Group, it was loaded with $4.8 billion in debt and drastically cut nursing staff. Patients were left unattended, and some died from bed sores and infections. The Carlyle Group extracted $1.3 billion in profits and walked away. Mervyn's Department Stores. After acquisition, it was split into retail and real estate parts. Then they raised rent on themselves, extracting $400 million. The department store eventually collapsed, leaving 30,000 people unemployed. But the real estate was sold separately for profit. How ridiculous are the rules? The most ironic thing is that private equity firms always say, "We bring professional management and improve company efficiency." But in reality, they're like locusts devouring one company, then moving to the next. They risk other people's money, burden the acquired company with debt, but always make money no matter what. It's like an elaborately designed game. Private equity firms are the players, acquired companies are the pawns, employees are the casualties, and they are always the winners. Final words. Next time you hear the term private equity investment, don't be fooled by the jargon. Simply put, this is a legal looting game. They're not creating value, but transferring it from employees, consumers, and suppliers into their own pockets. The financial world is indeed fascinating, but sometimes behind the fascination are the tears of countless ordinary people